If a portfolio drops from $100,000 down to $50,000, a 50% gain does not get you back to where you started. 50% of $50,000 only gets you to $75,000. Because you are starting from a smaller capital base, climbing out of the hole requires a much larger percentage gain. To actually recover that original $100,000 balance, you have to double your remaining capital. You need a full 100% gain. There is a precise mathematical rule governing this relationship. It is called the recovery gain formula. You divide the percentage you lost by 100 minus that loss, and then multiply the result by 100. When you plot this out, you see how quickly the math turns against you. A 10% loss requires an 11% gain to break even, manageable, but a 25% drop demands a 33% gain. By the time you hit a 50% drawdown, the required recovery skyrockets. During the months or years it takes to achieve those outsized returns, your portfolio's compound growth completely stops. Cutting losses early is a mathematical necessity to keep your capital working for you. So how do you keep losses small? Many retail traders rely on a static, hard stop, like deciding they'll always risk exactly 35 points on every single trade, regardless of the conditions. But the market does not have a static personality. If you look at a highly volatile market, a rigid 35-point bracket gets triggered immediately by normal price fluctuations. Take that exact same 35-point bracket and put it in a quiet market, and it is far too wide, exposing you to unnecessary risk. This chart shows the FTSE's average true range. The blue line measures daily volatility, currently averaging 55 points. Professionals use this baseline to set risk. Day traders set stops at 20%, or 11 points. Swing traders use 50%, or 28 points. By linking your stop distance directly to real-time volatility, your risk parameters adapt to the market's current reality. You stay safe from the random noise, but you avoid risking a penny more than necessary. This 5-minute chart applies the 20% rule. We have a MACD entry here, with an 11-point stop loss placed just below it. Because the stop is based on true volatility, it sits safely under the natural back-and-forth wicks of the candles. Let's test this logic on a different asset. Imagine you are planning a trade on the sterling dollar. The sterling dollar's daily ATR is 90 pips. Take 5 seconds, calculate your intraday stop at 20% and your swing trade stop at 50%. 20% gives a day trader an 18 pip stop. 50% gives a swing trader a 45 pip stop. Practicing this calculation turns your stop placement from a hopeful guess into an objective, repeatable reflex. We have an 18 pip stop on the chart, but how does that specific distance protect your total account balance from the massive drawdowns we mapped out earlier? The link between chart volatility and your total equity is a technique called fixed fractional sizing. It starts with a strict boundary. If you have a $100,000 portfolio, you establish a maximum risk limit per trade, typically 1%. That means the absolute most you are willing to lose on this setup is $1,000. Now you tie the two concepts together. You divide your maximum cash risk of $1,000 by your volatility stop distance of 18 pips. The result dictates your exact position size. Here is a summary of these rules to keep on hand. First, respect the steep math of drawdowns. A 50% loss requires a 100% gain. Second, use ATR to set logical stops. 20% for day trades, 50% for swings. Third, lock those trades behind a strict 1% account risk limit. Survival in trading does not come from perfect predictions. It comes from mathematically ensuring your inevitable losses are tightly controlled, leaving your capital intact for compounding over the long run.